All right, Honors Econ. We're going to get into investing today and investments, the types of investments. So, what Georgia wants you to know is to be able to evaluate the risk and return of a variety of savings and investment options, including savings accounts, what's called CDs, certificates of deposit, retirement accounts, is things like 401ks, stocks, bonds, and mutual funds. You do not need to write that down. I'm just telling you what you're going to get into today. All right, when we evaluate types of investments, we want to take a look at them with through this lens of risk and return. How much risk is there in me losing my money, and how much return am I going to get? Well, usually when it's lower risk, you're going to have a lower return. So savings accounts are considered low risk, low return. I do want you to write down this slide and the rest of the slides for your notes. Savings accounts are bank accounts in which people put savings to which they need easy access. So since savings accounts are very low risk, the rate of return is very low as well. Most banks pay less than 1% interest on savings. That usually doesn't even beat inflation, but it's a way of just kind of organizing your money, right? So for me in particular, I do have a savings account. I don't keep a lot of money in there because if I'm going to keep money long term, I'm going to put it in something that's going to earn more interest. A savings account I may just use if I plan on, buying some plane tickets in 6 months or so. I'll just set that money aside, and that way it's kind of helped me organize my finances, right? And most people use savings accounts like this because, again, they don't even usually beat inflation, so they're really not a way of having your money make money, all right? All right, certificates of deposit. These are low risk and low return as well. Certificates of deposit are products offered by banks. Buying a CD, they're usually referred to as CDs, means you will earn a higher rate of return than on a regular savings account. So usually, I don't think I've ever seen a CD that offers a return of more than, say, 5%. Most of them are probably more like 2%. The higher rate of return results from the saver agreeing to keep the funds in the CD for a specified period, usually between 1 month to 10 years. Okay, so if you do 1 month, the interest rate's going to be super low, but if you're willing to do 10 years, maybe you get in that 4% range, maybe you get as much as 5%. So the longer the period that you keep the money in there, the higher the interest rate. Now, is your money stuck in there? Well, kind of, sort of. All right. So people who save in CDs if they need to withdraw their funds early, you're going to pay a penalty for that early withdrawal. So you really, in order to get the return, you got to keep it in there for the specified period. Okay. And again, the shorter the period, the lower the rate you're going to get. The longer that you're willing to keep it in there, the higher the rate you're going to get, right? The rub, though, the problem is if you need access to that money because of an emergency, you're going to pay a penalty for it. Okay, retirement accounts, all right? The sooner you establish a retirement account, the better you're going to be. The most common account is a 401k. This is usually offered by companies. Now, me as a teacher, I'm not offered a 401k through Cherokee County. I'm offered a pension through the state. And then I'm offered what's called a 403b, which I put some of my paycheck in as well, which is just kind of an extra retirement account I have. But the most common, which most of you guys will have one day, is a 401k. All right, so for instance, my wife works at Piedmont Hospital. They offer a 401k. So she actually diverts 6% of her paycheck to her 401k, and then Piedmont matches that. So let's say 6% of her paycheck is $300. So my wife diverts $300 to her 401k. Well, then Piedmont Hospital will actually match that $300. So now $600 has actually gone into her 401k. Most companies don't offer a 401k until after you've been working there a year. But as soon as you can get a 401k with a company, you want to do it, and you want to max out what the company will match. Usually it's about 6%. So you want to be putting at least 6% of your money into that 401k. Because otherwise you're leaving money on the table, right? You're losing out on the company you work for matching those funds. Most of them are invested in stocks and bonds. You don't get to choose what stocks and bonds you're invested in. You just get to kind of choose how aggressive you want the financial firm that's managing it to be. So, for instance, my wife's with Fidelity, and my wife can tell Fidelity, okay, I want you to be really aggressive, or I want you to be more on the safe side. Okay, so more on the safe side would be more invested in bonds. More aggressive would be invested in stocks, high growth stocks. The risk and return depends on the allocation, right? So most older people, because they're not trying to get that big return, are going to be more in bonds. They're going to be more safe. But more younger people, because they can absorb volatility in the market, they're going to be invested in stocks. All right, so the risk and return is going to depend on the allocation. U.S. Treasury bonds. All right, so we talked about bonds a little bit in class. Purchasing U.S. Treasury bonds mean you have loaned the U.S. government money. All right, you bought the bond. What the government gets is they get money to spend to build airports and roads and bridges and things like that. What you get is you get an investment. The government pays you a guaranteed rate of return. All right. Since the U.S. government repays its debts, the rate of return is low. For example, the interest rate on a 5-year Treasury bond on April 27th was 1.822%. So if you buy this bond, let's say it's $100, you're going to get basically $1.82 back for owning it. All right. Now, if you own a whole lot, then that's a decent amount of money, but you're kind of keeping up with inflation there. You're maybe just slightly beating inflation. So it's a way of kind of preserving your money. It's not really a way of growing your money. All right. Interest rate on a 10-year, 2.3%. So maybe you've grown it a little bit because you've edged inflation just a little bit. Bonds are safe, but they also carry an inflation risk. If interest is paid is not higher than the inflation rate. So if inflation is like 4%, but you got a return of 2.3%, well, you actually lost money on this investment. All right. All right, stocks. Purchasing stock of individual companies is one of the more risky ways to invest. Now, when you purchase stock in large, stable companies, what are often referred to as blue chip stocks, this would be things like Costco or Walmart or food producers like General Mills or maybe grocery store like Kroger, right? These are pretty stable, right? So they're kind of recession proof. So if you actually go look at Costco stock, even though the stock market has taken a big time hit right now, Costco's pretty stable. The reason being is, right, people are still shopping at Costco, all right? So Costco would be considered a blue chip stock, right? But your return on Costco may not be very high. Maybe you get 5% every year, something like that, right? If you invest in companies with a shorter history or a brand new product, the potential return is generally high if the company succeeds, but it's going to be more risky, right? So maybe, you're a savvy investor and you're like, hey, I think this company is going to do a really good job I think they're going to come up with something that is able to combat, COVID-19 better. And if they do it, if they come up with this product, then you could see a huge return. But if they don't and they just simply go out of business, you're going to lose all your money. So that's why stocks are considered high risk and high return. Okay, mutual funds is a way of diversifying. So it's a way of investing in stocks, but it's a little bit safer, okay? So while individual company stock is relatively risky, many people choose to play the stock market by purchasing mutual funds, which is a blend of stocks. Mutual funds provide more protection against loss because the investment is spread across many different companies. So maybe the name of the mutual fund is Technology Mutual Fund, and it's invested in Apple and Samsung and Google. Well, maybe Apple has a really good year and maybe Google has a really good year, but then Samsung didn't. Well, still 2 of the 3 investments did well. 1 of them didn't. You still came out with a return. You still came out with some growth, but you didn't lose everything like you would have if you had invested just simply in Samsung. Okay, so those are out there. Most people that are not trying to keep up with the stock market all that much and just want to invest their money and not have to think about it, usually will invest in mutual funds. Some people, though, they will try to educate themselves, kind of become financially literate and choose which stocks they want to buy. Okay, that's it for today. That's these investments. So hopefully you got these slides down. I hope you guys are doing well, and I will see you tomorrow.